Most portfolios are not broken because of market corrections. They are broken because they were never built correctly to begin with. You have been trained to believe diversification means owning 30 different stocks across 10 sectors. That is not structural strength. That is dilution of risk without elimination of fragility. 100 eggs in 100 baskets still shatter when the table collapses. Here is the assumption you need to break today. Adding more assets does not create resilience. It only spreads exposure across the same systemic risk. Your portfolio is not weak because you own too much tech or too little gold. It is weak because it has no load-bearing structure. It has income fragility, concentrated correlation risk, and zero anti-fragile positioning.
Let me define structural weakness precisely. A structurally weak portfolio has 3 telltale signatures. First, its income depends on continuous economic expansion. Second, its risk assets all move in the same direction during a liquidity event. Third, it has no mechanism to benefit from volatility. That is not a portfolio. That is a weather-dependent crop. Now, examine your own. If your primary income stream stops, how many months of system integrity remain? Most of you answered 3 to 6. That is not resilience. That is a slow-motion collapse. Real structural strength requires at least 18 months of expense coverage in non-correlated liquid instruments, not cash earning 0, short-duration treasuries, private credit ladders, or income reserves decoupled from equity market beta. Without that, your entire wealth-building machine is one layoff away from liquidation. Second structural flaw, risk concentration disguised as diversification. You own an index fund, a growth ETF, a tech-heavy mutual fund, and maybe some individual names. Run the factor correlation. In a rising rate environment or a credit contraction, these all compress simultaneously. You have no uncorrelated return stream. True structural allocation demands at least 3 distinct economic drivers. Equity beta in productivity-sensitive sectors, inflation-linked real assets, and volatility harvesting strategies that monetize dislocation. If all 3 of your buckets are simply different flavors of long growth, you are not diversified. You are leveraged to a single narrative. Third, and most critical, you have no anti-fragile position. An asset is anti-fragile when it gains from volatility, disorder, and stress. Option strategies with defined risk, deep out-of-the-money put structures on overvalued indices, direct ownership of hard assets with embedded optionality, like undervalued energy or agricultural land with development rights. These positions look stupid in calm markets. They look insane in rising markets. But they are the structural bolts that prevent total system failure during the 10% of trading days that determine decade-long returns. You do not need a complex derivative book. You need a framework. Assign 50% of your portfolio to resilient income assets, high probability, low volatility, contractually obligated cash flows, private lending, infrastructure debt, or consumer staple equities with 2-decade dividend histories. Assign 30% to convexity assets that benefit from surprise upside, quality growth at rational prices. Assign 20% to volatility protection that pays when correlation breaks down.
That is a structurally sound portfolio. It does not maximize joy in bull markets. It survives bear markets and captures recovery.
Stop building for average expected returns. Average environments do not destroy wealth. Structural weaknesses exposed by tail events destroy wealth. Every major financial crisis in the last 30 years has been a story not of bad luck, but of bad architecture. Long-term capital management had Nobel laureates and failed because of concentrated leverage. 2008 had rated AAA collateral that failed because of hidden correlation. 2020 had balanced portfolios down 30% because everything correlated to zero.
You are not smarter than those markets, but you can be more disciplined. Eliminate income fragility. Decouple your risk exposures. Price in volatility as a feature, not a risk. And hold enough structural dry powder to reprice assets when others cannot. Most portfolios are structurally weak. Yours does not have to be. But that requires admitting that what you currently own is a collection of hopes dressed as a strategy. Hopes are not load-bearing. Systems are.
Build the system, or accept the fragility.